Right. I hope this stream is working. This is probably my third attempt
Stream is
to speak.
working.
Alright, it's
This
working.
is
Yeah, this is probably my third attempt today of trying to discuss about this topic. Um, yeah, it hasn't gone well so far. I started this morning, I recorded a 30 minutes just a video webcam like this and saved the file, but it was corrupted. It was corrupted the first time I did it. I spent a whole 30 minutes just speaking about what I'm going to speak in a few moments about gold. And yeah, it didn't work out well. I tried to recover the file, but now I've just set up my streaming OBS software. I think like this it's easier. I can switch my screen to as well. Yeah, so today I'm going to. This is my first video, and as a disclaimer, I'm not an official financial counselor or advisor. I don't have any accreditation, but what I do have is experience as a macro investment trader for more than 5 years now, and also as a sentiment trader. I didn't quite like the term, but I tried to give. My first attempt was as a forex trader, was a hype. That didn't work out well because it was purely speculation, and I went to the opposite, uh, completely opposite side of trading, which was more empirical towards what they call value investing. But it was not my style. You have to be very patient, and you have to analyze over thousands of pages and documents about companies and analyze their fundamental. But yeah, my strength finally is in trying to see patterns in the global macroeconomic environment regarding economics and how things ought to play out in the near future. At least I think I'm a bit good. I'm good at that. So yeah, a few friends of mine have asked me about gold. Is it worth considering to invest right now? And yeah, as you see here, gold has had an exponential growth over the past few years, and yeah, it looks like it's keeping on growing, and there's no stopping. But you'll see, like there's a kind of a hint at returning to the norm right here, which has been in the past few days, 2 weeks. So leading up to like a non-stop increase in gold asset price, and yeah, I even saw right now. I believe we are in gold frenzy. There were even people lining up at retail in at where the jewelries or the retail shop where they sell gold. There was a lot of people like in Australia. Yeah, you can search that up. They are literally lining up just to buy gold at this super high valuation, which for me doesn't make sense. So yeah, the answer is right now. Should you consider investing gold? No, that's it. So if you wanted that answer, you have it. You can uh, click out, go do better fun thing about your day. But yeah, if you want to know a bit more, you can stick around. I'm going to explain a few things. Uh, yeah. So how did that came about? What has triggered this huge ascension in gold prices? Uh, there is three ways to explain, not three ways, but three triggers that cause this, it's inflation, it's a lack of trust in the traditional financial system, and it's a change in global leadership, global superpower. So the first one, inflation, as you all know, as you all experience, after COVID, there have been massive price increases in retail goods and services, more than, from my personal experience, like groceries, it's more than 3x, 4x. And the property prices as well has hugely inflated. All of this due because central banks have been pumping more and more money in our money supply, and the more whatever currency you want to place it with, like you see here 2020, there's a huge pump in the money supply for dollar. So the more dollar is in circulation, the less your dollar in your pocket is valued at. The price of an apple remains the same, but the mode of payment through currencies has uh, the value in your pocket has reduced. Let's say it's like this. That's how inflation works, and a safe haven. So in like investment world, nobody really likes to take out their money and sit on cash. And a mentor of mine would say, follow the money. And when there's a huge inflation like this happens, people usually go for, there are two options. One is gold more so in times of uncertainty, and the equities market. And you see like even equities market has been returning more than 20% year over year, year on year returns. Equities market has been doing good as well. So the market has been performing relatively well. I won't say it's purely based on inflation. There has been some good earnings, especially regarding the big tech sectors. So yeah, so you have, either you take more risk, you go into equities market because you are going to, the share price are going to rise due to inflation, or you are more risk adverse and you go into gold. If times are uncertain, you would see like during the Trump tariff earlier this year, gold has been performing quite well as well. Oh, yeah, just I'm going to get back for a moment. So the trigger was a mix of initially inflation post pandemic, and then something very substantial happened in 2020. You would see like post COVID era, gold has been performing quite well, and it remained a bit quite stagnant, going up and down. And in 2022, it started to really go up. And I believe the trigger that caused this was when Russia attacked Ukraine, and the US and the G7 countries froze all their US dominated reserve assets, which was about $300 billion. So, what, this was never done in history before. This was the first time that we've seen that a foreign country can essentially seize your assets. So that created a lot of mistrust in the current financial system, and a lot of a lot of bank a lot of central banks around the world has been buying on gold more and more since then because of this lack of mistrust in USA for controlling the financial system. So they wanted to move more from US dollar to use for trading and more into gold reserve. So that's the second part. As first part I said was inflation. The second part is the lack of trust in global financial systems. Countries don't want to be exposed to a risk of if they do something wrong, their bank account would be frozen and they won't be able to access it. So that's the second reason why. And the third reason why is China China has been the country that has been really buying up all the gold reserve around the world. You see, like in 2020, it was around 2,000 tons, and now they have a bit more than that. Sorry, it's 19 19,000 tons. No, sorry, shit. Yeah, it was around 2000, and like it's more. But why they're doing that? They're trying to not catch up to the US dollar as a reserve fund, but they're trying to literally replace it. They want to replace dollar with yuan as the reserve. What's a reserve fund? First of all, it's what you use to trade. For example, when you go to your shop, when you're going to buy groceries, you're going to use the currency that's in circulation in your country. But how do countries trade among themselves? Is through a common denominated currency, which for a long time has been the US dollar. And China is on the rise as a global superpower to overtake the US. So they want to have not just to receive the global superpower status, you have to essentially sort of act like the bank of the world in a sense where every country uses your currency to trade. Because with this, you can essentially affect how the global market evolves through interest rates. Like you're currently like whatever the Federal Reserve in the US is the central bank, they decide to do regarding interest rates. You will notice like Europe, Africa, a lot of countries will follow suit because they are setting the tempo, they are leading the dance. So it comes with a lot of privilege to have your currency being used to trade. So this is what China wants to achieve. But people don't, a lot of countries do not trust China. So the way they're going about it is right now they've backed their yuan, their currency, with gold. So you can trade your yuan, it's pegged to gold, you can trade directly to gold. And they're establishing sort of what they call a gold corridor. It's in Shanghai. So instead of China having the gold reserves in their country, in their banks, uh, just to make other country more trusting to them, they've set it up in Shanghai, and this is why gold has been ascending massively these past few years. And coming back to the question, like, should I invest right now? Is it good to invest right now? We've seen gold in the newspaper, in news, a lot in the past week, and there's this sense of what we call FOMO, the fear of missing out. I would say no, because it's just too high right now, the price. And a small percentage of me would say yes, because we are going into a global economy where there's going to be multiple reserve funds. There's going to be gold. People are going to trade in yuan. People are going to trade in US dollar. And right now we even see like India and Russia are trading in their own currencies. They are not using yuan or dollar. They are trading in Indian rupees and Russian dollars. So yeah, it's everything is changing right now. Personally, I wouldn't have gold in my portfolio, because gold is not it's not performing, it's not behaving as it normally used to behave, as a safe haven. This is where you put your money when you think the world is going down, is going to collapse. But right now the volatility is super high. It's behaving like cryptocurrencies. It's behaving like meme stocks. And yes, for that reason, it doesn't make sense to go into it. But yeah, like I'm saying, it's just all speculation. Your guess is as good as mine. So then you may have a question where, like, as an investor, where do you invest your money, and if not in gold? And how I see the global macroeconomic panning out is, we know we've been hearing about how the Federal Reserve is going to slash their interest rates every quarter, basically, till mid 2026. And the chairman Powell might be on his way out mid next year in May. And Trump has been very vocal about more aggressive rate cuts. And what's rate cuts is interest rates. Like when you go to pay your loans, you have an interest rate. You've borrowed some money, you have an interest rate that you have to return the money back. So the central bank, he manages a base repo rate, the interest rate, and a way to stimulate economies is to drop the interest rate. This way, businesses takes more debt, invest more, increases job numbers, etc. That comes with it. It usually happens during a recession, and you many people believe we are in a recession this year, and I believe, just believing in this, like major proportion of the population just believing in we are in a recession, already leads to retail traders and institutions factoring in the, the price in the stock market. So the stock market prices right now is a reflection of the sum of everybody's beliefs and speculation. And yes, one how I see, interest rate is going down for sure, and when that happens, companies are going to invest more. There will be more earnings proportion, more earnings performance. People keep saying about risks such as the AI bubble. Uh, I was very careful. I was very risk aware about this last year, but after like analyzing more into it, there's still a lot of room to go. Like the bubble, it is there definitely, but near it's not nearly there where it's just about to pop, because when you look at the financials of the big tech companies, their debt margin is not, they are not over debt, they are not indebted as well, they haven't took out massive loans, so there's more debt buildup that can happen. And also there's this what we saw, Nvidia is funding OpenAI. OpenAI is taking that money and funding, not funding, but spending it on Oracle. And Oracle is going to take that money to build this warehouse, and is going to take that money and give it back to Nvidia for the GPUs, because ultimately the GPUs is what provide the AI power, and the major company that provides those GPUs are Nvidia. I think it's a bubble. It's definitely going to explode, but we the current situation is like what we had in 1999, just before the dot-com crash. And in 1999, the stock market nearly double and triple. If you look at this S&P 500, because at that point there was a market frenzy, and when interest rates shot up, that's when a lot of company went bankrupt and wiped out. And right now, I don't see, especially in the financial, in the tech sector, sorry, I don't see that happening. It may be a possibility in the real estate market, because what happened was quite comical. Since a few years now, real estate property developers have been selling properties uh, at to customers, and had them like refinance it. They had them take on like more than they can pay, and they said one way to kind of like one way they had them uh, one way they had them like believe that they could actually afford something that was a bit higher than what they actually could, was that they said to them like, don't worry about it, next year the Federal Reserve is going to drop the interest rate, and you can refinance your mortgages at a lower interest rate. And yeah, a lot of people fell for it, and right now you can see a lot of mortgage delinquencies with and late payments, because that hasn't actually happened yet. But I'll give it another year for it to happen. So I've heard like in San Francisco and California as well, some property developers went out or business went bankrupt. But I don't see it big risk for the global financial market. For me, the way that I have my portfolio set up is staying away from uh, US dollar. I have a huge portion of cash, but not in US dominated currency. It's more into like Swiss franc, Norwegian krona, Singaporean dollars, just to stay away from depreciation. Because since this year, the USD lost 20, not 20, 10%, 10 to 15% of its power relative to other currencies. So, in short, it it's been devalued, and it's going to continue to be devalued till next year, till 2027. Trump said it in the Mar-a-Lago Accords that they want to devalue it till 25% just to make American export more competitive. So I would stay away from US dollar just to not take that 25% hit, and the let's say 50% you're in cash in different currencies, just to hedge against currency devaluation, and your other 50%, it could be up to you. uh, do do you want to be in equities? And I believe right now it's good to have an exposure to equities, because the market is uncertain how it's going to go. Everybody's is very wary about this potential AI bubble, and that's when you get in the market, basically when everybody's do what has done me good over the years and gave me good performance on my portfolio is just to do the opposite of what everybody else is doing. And right now everybody else is very uncertain, is not really invested in the market, and I have reasons to believe, like I mentioned, that it is a good time to get in the market and just ride this loss like returns you're going to get before everything, yeah, everything does like what happened in 20 in after 1999 in the dot-com bubble crash. And yeah, and the trigger would be watching the major companies, how their balance sheet is and how much in debt they are, and also taking a look at inflation data. And because ultimately inflation data is going to make the Federal Reserve decide on whether to raise back their interest rates up, or yeah, just keeps on dropping down. Right now inflation is pretty good, is within the margin of maneuver for the Federal Reserve. There has been a lot of layoff in October this year. There has been the last time there was as much layoff this October was in 2003. And the less people you have in your labor market, inflation kind of goes down. The more people you have employed, the more inflation you're going to get. So this gives room for the Federal Reserve to continually drop their interest rates, and is going to be more aggressive next year. So by mid 2026, we can expect more aggressive rate cuts when the chairman of the Federal Reserve, he has been replaced, likely by it would be likely by a Republican leaning candidate. And like Trump mentioned, he wants aggressive rate cuts. And after 2026, we are going to in 2026 we are going to see like a massive debt increase to the big tech the big tech companies, because they want to keep pumping out their earnings, and that comes with like a large investment. Right now they have been investing massively, but it's not really showing one to one on their profit and loss margin. But it's more like an AI race right now. And yeah, like I mentioned, like there's more steam to blow on this train. And that's kind of how I would go about my portfolio allocation strategy, is to not completely be in cash and wait for when it's going to crash. I made that mistake since December. I did get some returns with fixed incomes and bonds, but it was not quite uh, quite as performant as the stock market has been returning. So I made a bit of change in my allocation, and that's the way I'm going now. And I do have some investment in Bitcoin as well, and people who know me know how against cryptocurrencies I have been. Uh, yeah, since it was first created, but right now I see the usefulness of it, and I see how it's going to compete in like this new financial systems that's setting up in motion with gold that China is doing with gold and yuan. And yeah, I can talk more about Bitcoin if you guys want me to. Uh, just yeah, just comment, just write it in the comment. I can make another video just talking about cryptocurrency, but like cryptocurrency is mostly Bitcoins, users, or rug pulls. I haven't quite looked into Ethereum and XRP. Yeah, I can talk a bit about Bitcoin. Just let me know about it. Yeah, that's it. I hope you guys have learned something about what's going on with gold and if it's worth your time and attention and your investment. Personally, no. If you see it's something you have to invest in for the next global economy, maybe have a small stake in it. I would not go at this price. I wouldn't go more than 5% allocation to your portfolio in gold, but it depends on you ultimately. So yeah, that's about it. I let me know if you like this video. I will do more live streams and more video like this in yeah next time. All right, then. Toodles. Have a great night, you all.